We certainly had quite the day from Confluent yesterday, didn't we? Q2 earnings and the stock lost a third of its market cap, crashing 33%. So that is a massive, massive crash. Today, I'm going to talk about what went wrong, particularly given that I only recently released my Confluent deep dive, what I thought on the results, if the crash was warranted, and I'll let you know if I'm going to be buying any more. So, what did I not like in the quarter and what went wrong? So, Confluent still have a relatively small customer base of large customers that bring in most of the revenue, right? The vast majority of the revenue comes from those very large customers generating millions a year in ARR. And one of the large customers, which is anonymous, but AI native, is migrating off the Confluent cloud, shifting workloads to self-managed infrastructure. I mentioned this as a risk in my original deep dive because Confluent is there as a low, no-code managed platform to help organizations build and set up open-ended software like Apache Kafka, which is what Confluent is built upon. However, when an organization gets large enough, sometimes they will switch to self-managed, as Uber did. And it's just about if the companies have that risk-reward balance right. Now, from my research, the bull thesis on Confluent is agentic AI is coming and companies need to act fast. Most companies are just not going to have the budgets, particularly with everything else that they are trying to do in AI. They're not going to have the budgets to actually build all of this open source data infrastructure themselves, and hence they're using Confluent. So the fact that a large customer migrated off Confluent is not necessarily bearish for Confluent, but it just sounds like it's unfortunate, right? And it would be more likely the largest customer or one of the largest customers that migrates off Confluent, because Confluent as a consumption-based model, it's just likely that is going to happen because the risk reward for that customer, as their live data pipelines get crazy and more complicated, is to potentially go in-house. So that's a risk to that overall business. Another thing that I didn't like, just to start off with not liking, Confluent didn't report their total customers explicitly, so we don't have that number for the quarter. Now, it was nice because in the last quarter, I pointed out that there's been an acceleration in total customers over the past 5 quarters, and that has since ceased in the last quarter, coupled with the fact that their cohort from 20K ARR to 100K ARR, that growth is also slowing down to, I think it was 10%. So they've had slower growth on that side. They're still growing their 1 million ARR customer cohort by 24%, but they've had slower growth on the land. What we've got to remember, Confluent are very much an expand business, right? Customers, for 2 reasons. Number one, it's a consumption-based model, right? So you've got that leverage there. Customers are paying for what they use, so expand is exceptionally important. So from there, we can, discount a little bit the fact that, okay, maybe we might have had a slowdown in total customers, which is why they're not reporting it. However, we need to look at the trend going forward, because if we're seeing a trend on the low end, and in the earnings call, they were very, very straightforward with the fact that we've been focusing on our enterprise customers, right? They said that they were not focusing on this 20K to 100K cohort, and for good reason, right? Because if you think about it, the customers with the largest ARR, they are going to be the ones that are the most ready to move towards this live, self-learning, reactive agentic AI sphere, right? They're going to be the ones. So Confluent are capitalizing on that opportunity first, but they did. There was a tone of neglect in their voice when talking about these lower cohorts, right? So fair enough. Like, a management admitted their mistakes, and I quite like Jay Krebs and his team on this. They're sort of the more cool, calm, collected, tell it straight CEOs. He's not flashy. I really don't think he's a bullshitter. And he believes in a long-term platform, but they're saying that this was like a short-term oversight on their part. So we've got to mention that, yeah, Confluent is a massively expand business because of consumption-based model, and also just because of the fact that businesses AI or agentic AI is going to get more and more complicated, and the bull case is obviously that agentic AI is going to take over large parts of companies, and that's how they're going to be run. They're going to need agentic AI for so many things in order to improve customer experience and basically help their customers solve problems. So yeah, Jay Krebs acknowledged heading into the year, I do think we've made some changes that lost some focus, too focused on the large customers, and their internal coverage models weren't optimized to serve the midterm bands efficiently. Fair enough. As I mentioned, sorry, it's not 1 million it's not 1 million plus that make up 90% of ARR, it's 100 plus that make up 90% of ARR. So the average customer is still spending hundreds of thousands of dollars a year with Confluent, and the 1 million ARR customers still grew 24% year on year, which is not a deceleration from last quarter. So that's positive. But obviously we do want to see the land, and I think we will, because the agentic AI era is going to come to those smaller companies later. That's the long-term thesis. And management did say, they reiterated a lot about this core thesis, which is Confluent is extremely well positioned in the next phase of AI, right? It's a picks and shovels play. For example, one of the analysts asks, you pointed out, is it just a growth in AI production workloads across a couple of hundred customers? I guess I'm wondering, it feels like to us the relevancy of streaming and processing is elevated in an AI first world. How should we think about some of these production workloads? Jay Krebs says, ultimately, this is turning into a really important ingredient in the architecture for artificial intelligence applications, and it makes logical sense. If you want to have some kind of agent that's taking action in the business, it has to have an up-to-date set of context data on what's happening across the business, right? So that is literally the thesis for Confluent in a nutshell. And the CFO also stated, Confluent's strategic importance in AI is only getting stronger as the world expands from Gen AI to agentic AI. Over the past year, we've seen first-hand use cases in production growing from chatbots, semantic search and content creation to code generation and iteration, multi-agent orchestration, agent recommendations, and much more. As Jay mentioned, this year we expect the number of production AI use cases to grow 10x across a few hundred customers. And I think, then the next question comes, is this crash warranted, right? Because yes, they had a large customer exit. Yes, there's been some slowing of growth. On the other hand, they basically reiterated their full year revenue growth of 20%, and they even upped the bottom tail of that a little bit. So they're not upping their guidance, but 20% revenue growth forecasted, that's unchanged, which is not much of a slowdown from the 24% they did last year. Their 1 million ARR customers are growing 24%, and yeah, it's not much of a slowdown. They Confluent usually beat with a range of about 1.5 to 4% revenue growth. So in a bull case for that, we may see an uptick to 21% if this is just a headwind for a few quarters. But the point is that I think there's an element here where the stock deserved to crash. If I had watched the results before the share price had moved, which I didn't do because I was asleep, because I live in Australia, I would have expected the stock to fall. I would not have expected the stock to rise, right? But you have to say in context, is it warranted a 30% crash given the shares were at the cheaper end of what they've been over the past few years, and you have a massive AI opportunity that Confluent are ready to capitalize on that's just not showing up quantitatively at present? That's basically what you've got to weigh up. And I would say, obviously this is another thing, right? Like the stock is bouncing in a range. It's bounced in a range for the past few years, from $18 a share to $35 a share, thereabouts, right? I'm approximating, but bang, 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 bang. And at the same time, whenever it gets to the bottom of that range, it's exceptionally cheap, because at the same time, Confluent are growing their revenue. So if the stock was at the top end of that range, $35 per share pre-earnings, which would price it at about 16 times market cap present day gross profit, that 30% drop, I reckon, would have been warranted. But trading at $25, maybe $26 a share, 12.5 times market cap enterprise value to gross profit, I would not have expected the stock to fall 30%. I just don't think it's worth it given the risk reward. You know, I already mentioned this stock is priced pretty cheaply relative to historics and other growth companies. It has its issues about high SBC, genuinely high SBC, compared to other tech stocks that have high SBC, right? So that's an investment in talent, and they have their issues around share dilution, which actually I was quite happy with how that looked in here, and they're looking like they're going to have another year of positive free cash flow for 2025, so that's great. But yeah, the ratio went from about 12.5 market cap to gross, maybe 13, now it's down to 8.5 times gross. They're still forecasting the 20% revenue growth, which I reckon they will do a small beat. We might get 20.5% revenue growth for the full year, because I think this quarter they're just saying, let's take the hit and be a bit conservative. You got to remember, it's the cheapest valuation it's been at, and it's picks and shovels, right? And the stock's crashed 33, but in order to get back to where it's got, like where it was, that's not a 33% gain, that's a 50% gain, right? You know, 100, well, that's not a good idea. 99, 33% crash down to 66 is then like a 50% growth of 66 plus 33 back to 99 again. So there's that. It's like now it's trading at very good value. And I just think that, you know how Wall Street are, they're very focused on the quarter, they're very focused on near-term headwinds. And I'm reminding myself that we are in an age where this is a picks and shovels play in artificial intelligence. There's no doubt in my mind that we're going towards live AI agents, which are going to increase productivity hugely in the AI space, right? That's really how you get AI working productively, and Confluent is here to be a big beneficiary of that. There's not a lot of evidence that the hyperscalers are taking a lot of market share, although that is still a risk at present. I didn't really notice anything in the earnings call about that. And of course, the risk present that, look, larger companies, when it's worth for them to deploy their own infrastructure in-house, they obviously will. So that's going to happen. Like Confluent are going to use a bit of customers. I think the retention was about 90%. So some companies are obviously going to do that. But the flip side of the thesis is then when it's speed and companies just need to start working on agentic AI to literally survive. And I don't think that's really going to hit until, you know, the back end of this decade, but that will really speed this all up. And Jay Krebs, founder of Apache Kafka, he's got the co-founder of Apache Kafka with him, his name escapes me. They founded Confluent together. They're the dream team to capitalize on this data in motion industry. So, spoilers, I am going to be adding to my Confluent position. This was not a good quarter. I'm not saying the market's crazy for selling it, but given where it was before, and given that the long-term thesis is intact, and management reiterated that, but they've mainly reiterated it qualitatively rather than it showing up in the numbers yet, and they've had some short-term headwinds. I understand why the market sold off, but I'm just saying, given it was only at 25 beforehand, at the lower end of that range, now it's at 8 times market cap to gross profit, and they've reiterated the 20% revenue growth, which is only a slight slowdown from a 24% before, and we may see a bit of reacceleration as this opportunity starts to show up in the numbers. I reckon it's really good risk reward. But again, it's not without its risk, you know, you don't just get reward and no risk. The last point I wanted to make, which actually made me a little bit bullish on the stock, or a little bit more bullish on the stock since I published the video, or at least since I recorded the video, is I found out that Jay Krebs is on the board of Anthropic, right? And they're the company partnered with Amazon and developing the large language model Claude, which is probably in 3rd or 4th place in the LLM race. Anthropic are doing exceptionally well. And Jay Krebs is one of only 5 people on that board. I think Reid Hoffman's on the board. Don't quote me. I can't. Maybe it's not Reid Hoffman. Anyway, there's only 5 people on the board. 2 of the people on the board are the co-founders, and Jay Krebs is on that board, and it's something that made me a bit more bullish on the stock, particularly because Confluent is a picks and shovels play on AI. Given that Anthropic is treating, you know, every board member with great care, they're picking them with great care. That's very, very bullish for Confluent, because it's showing that, number one, Jay Krebs really knows his stuff when it comes to AI, and they trust him as a competent leader to lead what is a huge opportunity in the large language model race, particularly when you're partnered with the largest cloud provider in the world, Amazon Web Services. And it's also showing that, J Krebs will both be able to, because of that experience, implement AI into Confluent's platform effectively, but also really understands their customers' needs. Also customers that are not right at the forefront of AI, otherwise they'd probably be building their own data infrastructure in-house, right? But companies that they're not necessarily AI native, they're probably digital native, but they're not necessarily AI native, and they're trying to understand this next phase of AI that we're moving into and how to integrate it into their organization, how to make their data flow. A lot of companies' data is unstructured and scattered and messy, and that's what Confluent seamlessly bring together in a reactive way. And that's where the alpha and AI will be generated. Confluent will have the expertise to be able to create a platform to really help those customers. So I'll reiterate, Confluent stock is not without its risk. This was a bad quarter, but nothing that shatters the thesis. And I think a 30% drop, given that the stock was already in its 80th, maybe 85th percentile of cheapness since IPO, and it's now in its 100th percentile of cheapness since its IPO based off forward price to sales, etc. I think it represents an attractive risk-reward opportunity.